Futures higher once again, although the past couple days it's turned sour. 5 days of losses. We are 30 minutes from the start of the cash trade today. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, no deal. President Biden blocks Nippon Steel's bid for U.S. Steel, ending a year-long saga over the future of an American industrial giant.
And car sales get an electric boost from Trump's threat to eliminate tax credits for EVs, but the surge isn't expected to spill into this year.
And smart money from Millennium to Citadel. Multi-strategy funds delivered double-digit gains in 2024. A strong year for the hedge fund industry. All of that and more coming up. But let's take a look at where markets are trading. Like Matt said, we had a down day yesterday. Technically the worst day of the year. You can see we're seeing a little bit of a bounce this morning, though, up about 0.2%, 0.3% when it comes to the S&P 500. Same story if you take a look at big tech, of course. A lot of people still on vacation, so I don't know how to read too much into this, but you take a look at the bond market as well. You're seeing a little bit of a bid materialize, but similar levels to where we were yesterday, Matt Miller, currently just above 4.5%.
I can tell you're actually thinking about Mike Johnson, and that vote starts in just about an hour's time, so we'll keep you up to date on the speaker race. Taking a look at what's going on with Bitcoin ETF, this is really an incredible chart. $54 billion of inflows over the past year. But in the last week, we saw the biggest week of outflows on record, more than $300 million in outflows. So BlackRock's Bitcoin ETF looks to get a little weakness at the start of 2025.
Wonder what that says about risk appetite. We're going to talk about that more. But before that, some stocks we're watching. We were talking about U.S. Steel. President Biden blocked a $14 billion sale of U.S. Steel to Japan's Nippon Steel, saying that the company should be American-owned and operated. And we're going to talk more about that in a moment. But for now, it's down almost 8% pre-market. Looking at Rivian on the rise, up 4.6% pre-market as well, climbing after reporting fourth quarter deliveries that topped estimates. The company says supply chain shortages are no longer an issue. And finally, Stellantis had lost access to a $7,500 U.S. tax credit amount under tougher rules that took effect this week. It applies to certain plug-in EVs. Stellantis now down 2.3%. That stock has seen a lot of pain in recent months, Matt.
Yeah, a lot of pain. I'm looking at Rivian. Since it started trading, down 83%. Maybe today is a good omen. Maybe 2025 is going to be that car maker's year. But there's a lot going on today. A lot of bad news, right? U.S. Steel down. Alcohol producers going to have a cancer warning label.
Yeah.
But Rivian's good news.
Rivian is good news, a drop in the bucket, of course, relative to their experience since they IPO'd. But it's interesting. If you zoom out and you look at this market, Isabel Lee had a great note in our morning newsletter about the Santa sell-off. Basically, seasonality has gone by the wayside. And I think a lot of it comes back to the Fed. You think about that December 18th Fed meeting, that hawkish cut. Really, that's when the narrative changed. And bond yields have gone straight up since then.
And if you're afraid of short-term rates, then how afraid of you are long-term rates? That idea that you've been pointing out, that short-term rates have fallen, yet the long-term has risen. That 4.5% danger zone that we've talked about, we're sustainably above that now, and that has coincided with that weakness in the stock market. Really off almost 4% now from its highs.
Yeah, but the uninversion is something I'm going to focus on in our next interview. Dive into these markets with Crossmark Chief Market Strategist Victoria Fernandez. And Victoria, before we get to the financials, I know you like that trade. I want to ask about the broader market. It's been a really disappointing December, down 2.5%. The Santa Claus rally really didn't materialize. Is that malaise set to continue into January, into Q1 for stocks?
Yeah, today's our last day, perhaps, to see a change in the Santa Claus rally. And I just don't think it's going to happen because what you're saying, I think, is exactly right. We're going to have this volatility and this falling sentiment. You know, sentiment had reached extremes a few weeks ago. Now it's starting to come back down, and there's a lot of volatility going on. And I think there's good reasons for it, Matt. I mean, obviously, the Fed, you guys are talking about the Fed. Come January 20th, we probably have some executive orders coming our way that people aren't exactly sure how that's going to affect back the market, whether it's around border security, whether it's around tariffs. We'll probably have something pretty quickly coming in there. We still have geopolitics issues, yields, which you guys are talking about, and that longer end of the yield curve going out, not because of inflation concerns, but because of term premiums, and that's something that can continue to cause volatility. We've got a potential strike January 16th. There's a lot that can cause volatility, and that's what we think we're going to see for the first quarter of this year. So I wouldn't be surprised for sentiment, even though typically it's pretty strong in January, to not be such a tailwind.
It seems to be a very catalyst-driven market. A year ago, we would be talking about those dates upcoming in terms of economic data points, Fed meetings, and now you're putting in strikes and executive orders into the equation as well. With that kind of volatility potentially expected, what's the floor on the S&P 500 as you calculate the downside risk?
Well, I don't know exactly what the floor is, but what I can tell you is that we keep going back to kind of where those October highs were, right around that 58 to 5,900 level. We're kind of right in the middle of that right now. I wouldn't be surprised if we stay in a trading range somewhere around there. Now, I also wouldn't be surprised if we have a larger pullback. This may be the time that we've been talking about probably for the last 6 months, where we were expecting a larger pullback in the market. All of these catalysts that we're talking about, perhaps this is the moment where they all come together in the first quarter of this year and we get a larger pullback. Maybe we get a 7 to 10% pullback. I don't think we probably go into a full-on recession. But if we do, based on what I think will probably happen throughout the rest of the year, it's probably a good buying opportunity.
Interesting. So a 7 to 10% pullback, and that, of course, is maybe an entry point there. If we do see that sort of pullback materialize, what's leading it? Is this tech-led? Is this sort of the biggest names leading us downwards? Or do you see this broadening trade that we've been talking about deteriorating further?
Yeah, that broadening trade, I think, is really key. People were anticipating that, and we actually saw the market broadening out towards the end of last year, and then it flipped on us pretty quickly. I think it's going to be a combination of elements that bring us down. I don't think there's going to be one trigger. I think it's the concern around the debt. I mean, you guys were talking about the speaker vote today. This is just the start, I think, of a lot of headlines coming out of Washington over the next couple of months. So it can be a combination of Washington, debt moving higher, bond vigilantes saying enough is enough and pushing yields higher. Let's see what happens with earnings. Earnings have been really strong, and market is anticipating double-digit earnings growth again this year. That seems like a really high bar. I wouldn't be surprised if we have maybe less than promising earnings come out, and that could be one of the triggers as well.
You list some drivers to the upside, earnings being one of them, right? If we make those targets. Sentiment is good. It still seems pretty bullish to me. And then liquidity is another one you mentioned. So I looked at the M2 money supply, and I saw that over the last year, the slope has been steeper than it was in the pre-pandemic decade. That's, I guess, good for stocks, but also could be bad, right? If it means inflation could come back. What do you think about that concern and the accompanying Fed moves?
Yeah, so liquidity is a big driver of momentum in the market. And you're right, M2 money supply has gone up pretty much. And so that's a positive for this market. And we'll probably have additional liquidity, Matt, coming in the first quarter of this year. If we hit this debt ceiling, well, we have hit the debt ceiling, but if they don't increase it, the longer that goes on, the more that the Treasury has to bring in money from their general account. That's adding more liquidity to this market. If you have the Fed cut rates, that's easier money, and it adds to loan growth and other elements as well. So yes, that's positive from a liquidity standpoint, which is good for the market, but you're also increasing demand as that money comes into the market. So you're right, there could be an inflationary tone to it. It's a very tight balance right now for the Fed, I think, between what inflation is going to do and the labor market. They were so focused on the labor market thinking inflation was handled. And now I think over the last month, they've realized maybe that's not the case. It makes their job pretty difficult.
I also want to cite here back to what Matt wanted to ask you about the yield curve and the financial system, because you do see the 210 curve sitting at a 30 basis point differential. It is a steepener's dream. And you also see longer term rates staying high, which could bode well for net interest income. notwithstanding that there are some concerns about consumer delinquencies and charge-offs rising, where we stand in the economy right now, how do you think about the balance of risks as we head into earnings season for the big banks in just a couple weeks here?
Yeah, obviously that steeper yield curve, like you said, will be positive for that net interest margin. And the balance sheets are so strong for these large banks right now. I mean, you compare it to where they were a couple of years ago when there were concerns with the consumers, and that was a completely different story. There was a lot of concern and volatility with those bank names, but their balance sheets are much stronger now. They can handle things like that. They have larger reserves put aside. So I'm not worried about the banks, even if we see some of the delinquencies move higher. But it's that high-income consumer that's really been driving a lot of the consumer movement here in the economy, and I think that will continue to happen. But look, credit card interest, $170 billion paid in credit card interest the first 9 months of 2024. That's a lot of interest there. I think we need to see some of that come down, but we have seen household financial assets up 13% year over year. So there's some cushion there. But I think banks are going to be a good buy going forward, especially with the pullback that we've seen over the last couple weeks.
Victoria, we don't have a ton of time left, but before we let you go, I do want to get your thoughts on a puzzle that I've always been wondering about when it comes to financials and the yield curve. Because, Sonali, I know you said it's a steepening dream, but the 2-10 curve is only at about 30 basis points, which isn't negative 100, but is it the direction of travel or the absolute level that matters?
No, look, when we get earnings reports, it's always the guidance, right? It's not the actual numbers that are important. So I think the banks are looking at what is the trend. Is it going to continue to get steeper? And it looks like if term premiums continue to move higher, they will get that. And if the Fed continues to cut rates, that lower end will come down. So I think banks are saying they could get a little bit steeper from here. But even if they don't, they're in a much better position than they were over the last 18 to 24 months. That will be positive for their margins and for earnings.
All right, Victoria, thanks so much for joining us. Crossmark Chief Market Strategist Victoria Fernandez talking us through markets at the top of the program. We are going to continue to focus on these markets and some of the specific stock stories. U.S. Steel and Nippon Steel may take legal action after President Biden formally blocks that deal. You can see the shares down 8%. This is Bloomberg. Let's get now to high interest, look at what's making headlines around the world. Congress convenes this morning, and House Speaker Mike Johnson is up for re-election. Johnson is confident, telling Fox News that he had the most important endorsement he needed, President-elect Donald Trump's stamp of approval. In a post on Truth Social earlier today, Trump said Johnson is, quote, very close to having 100% support. But it's not quite that. The U.S. Surgeon General Vivek Murthy is calling for cancer warnings on labels of alcoholic products like beer and wine. Vivek Murthy said less than half of Americans are aware of the risks, pointing to heightened risk of developing breast cancer and tumors in other parts of the body. Shares of European drinks makers are falling on the news. And the Fighting Irish won this year's Sugar Bowl after upsetting Georgia 23-10. The game was played in the wake of the deadly terror attack in New Orleans after being postponed one day. Notre Dame will now play Penn State in the Orange Bowl. Meanwhile, Texas will take on my Ohio State Buckeyes in the other semifinal matchup next week. I'm very much looking forward to another national championship. Sonali?
Now, we're going to talk about a deal we've been watching closely for the last several months, really, Matt. And we're talking about President Biden blocking the $14 billion sale of U.S. Steel to Japan's Nippon Steel. I will also say you called it very early on, Matthew. The companies have signaled that they will pursue legal action, so the story is far from over. Bloomberg's Joe Doe has been covering the saga throughout. I want to read you a quote here because this particular view is far beyond the consensus, and that is that of Terry Larry Haynes at Pangea Policy, who thinks that Trump will likely change Biden's decision. And there's very likely to be no Nippon Steel specific or Japan specific national security grounds for Biden's decision, one of which are required by law, which makes the decision, this is according to Haynes, illegitimate at best and illegal at worst. How do you think the Trump administration would view this deal? And is this view, do you think, predicated on the idea that ultimately U.S. Steel might need this deal?
I mean, listen, the President of the United States has codified in statute the ability to kill a deal. I know that President Donald Trump has said, and he said last month very specifically, that he would kill this deal. As to whether or not he might not kill this deal, I don't even know where to begin. I don't think we're there yet. I think that this deal, as of now, looks like it's dead. I mean, if you look at the way the stock is trading this morning at about $30 a share, that's implying that a lot of the arbitrators are saying that this is dead. I don't know. Trump is still 20 days away from being president, but right now, I mean, this thing is finally dead. Joe Biden finally followed through with what he's been saying, which was going to keep the company an American company. And listen, again, Donald Trump has said throughout the campaign and again stated after the election that he would kill this deal. He did not want U.S. Steel to be a Japanese company.
Yeah, at least going by the words spoken from the horse's mouth, it seems like President-elect Donald Trump is spiritually similar towards the deal as President Biden. But let's talk about what could actually happen now with the deal finally being dead. Does U.S. Steel survive as a standalone? Does it restart the sale process? What is in the realm of the possible?
Yeah, I think they're going to have to kind of think things through. Do they survive as a standalone company? Yes, of course they do. They bought Big River Steel, which was an EAF back in 2019 down in Arkansas. They doubled the capacity of that mill. It was widely viewed by the market at the time as a expensive purchase, but in the long run is a purchase that saved U.S. Steel. There were always questions about the integrated mills, in particular how much they would have to spend to rehabilitate those mills. What do they do next? I think the board is going to have to make a lot of decisions. They're going to have to ask themselves, what is the future of the CEO, Dave Burritt? They're going to have to ask themselves, if we sell, are we going to break things into parts, you know, the integrated mills versus the EAFs, or are we going to try to sell it whole? And it's unclear who those bidders might be. Cleveland-Cliffs obviously had the second highest bid, a $54 cash and share offer back in December of last year. But since then, they bought another company, and they've also had a lot of trouble throughout the year because pricing has been down, and there are questions of whether or not they can afford to make other acquisitions. So I think a lot is still up in the air, especially as, I mean, the dust isn't even settled yet.
What is the problem with steel? I mean, people need it to make stuff, right, Joe? We have some car manufacturers in this country that use a lot of steel. Is the problem that it comes in cheaper from Asia? And if so, wouldn't tariffs address that issue?
Listen, I think to answer your question, Matt, I think you need to look at it at a company by company basis. If you're talking about Nucor Corporation or Steel Dynamics, people in the markets look at those companies as very strong companies, A+ bond ratings. They're dependable. They don't have to do massive shutdowns because of the way EAFs work. You look at U.S. Steel, for example, though, and they haven't really done massive upgrades to some assets. As we point out in the Mon Valley, that's the same asset that traces its roots back to Andrew Carnegie back in the 1900s, 1901. So I think it is more a company question. Remember, the United States still consumes 65% of the steel that we consume in the United States is made in the United States. And then we produce over 100 to 120 million tons of steel per year. So I think oftentimes it does get lost, especially because the former president, President Trump, had often said that the industry was dying. It, in fact, isn't dying, but it does. When you look at companies like U.S. Steel, there are massive questions by investors because so many of the assets are so old, and there are questions around the labor costs and everything else that goes with it.
All right, Joe, great to have your insight and your reporting here. That is Bloomberg's Joe Doe. And this is an interesting one, guys, because it's being blocked on the basis of national security, which is a really broad church at this point. You can make a case for TikTok, of course. You have all of this American data, but national security in this deal, Japan is an ally.
I was thinking that with the relationship becoming ever closer. And that's why, for me at least, I am continuing to watch it. If they're going to dispute the decision, then what happens? You have to remember also that you have the stock trading in the 30s now, so well below what Cleveland Cliffs was offering back then, which would, in theory, make it more attractive to maybe other buyers.
Yeah, I mean, Japan is an ally.
Yeah.
But you want to keep certain industries within your own borders.
I guess if U.S. is in the name, ideally, it would remain American.
Right, and especially if you're running on an America First platform.
That's a split.
On the other hand, Donald Trump was against Bitcoin. Now he's its biggest, fan. Donald Trump was against TikTok and the Chinese spying on us through that social media app. Now he's pushing to keep it Chinese. So
the strategy I'm taking into this year is anything goes. You don't know what's going to happen. All things can change.
We'll see, of course, and maybe Terry Haynes will be proven right. But in any case, coming up in the next hour, we'll speak to the CEO of another industrial firm, Agco, and we're just 8 minutes away from the market open, so don't go anywhere. This is Bloomberg. Welcome back to Bloomberg Open Interest. A check on futures as we count down to the opening bell. You can see there's green on the screen. We had the exact same setup yesterday morning, though, and we know how that ended. But at least for right now, the S&P 500 higher by about 0.5% in the pre-market. The Nasdaq 100 a little bit better. The Russell 2000, an interesting one. This index, the small caps, actually ended very slightly positive yesterday. That was your outperformer. Not quite your outperformer today, though. The Russell 2000 currently higher by about 0.4%.
It did actually massively outperform the S&P 493 last year and the year before. Did you see the data track note?
Fascinating. I missed that part of it.
Yeah, so Nick Colas and Jessica Robert Data Track pointed out that if you take out the Mag 7, the Russell 2000 did better than the rest of the index.
But it's down 4.5% since the Fed cut rates on December 18th. In any case, the opening bell, less than 4 minutes away. Don't go anywhere. This is Bloomberg.
All right, we are moments away from the start of trading. This is Bloomberg Open Interest, and futures are up. Although we've gotten this kind of head fake the last couple of sessions, we are now down for 5 trading days in a row at the end of the day. So we'll see if big tech can save us today. You can see the S&P futures up 0.5%, but NASDAQ futures up a little bit more, about 0.6%. The small caps doing worse than both of those, although they're all kind of on the same level here. You can see, and hear, I guess, the opening bells. By the way, here at the New York Stock Exchange, I have no idea why, but the Professional Bull Riders Association is ringing the opening bell with the Austin Gamblers, who are apparently championship bull riders. I did go to a rodeo at Madison Square Garden once, and it was super fun. Down at the NASDAQ market site, Modern Health is ringing the bell. It's a mental health platform, and as you know, likely, we take mental health very seriously. In terms of the major averages right now, Katie Greifeld is looking at the gains. Katie, what do we see?
I have to fact check, but I think that rodeo at MSG is in January, so something to look into the commercial break. But in any case, we do have green on the screen, of course. You can see that the S&P 500 up by about 0.5%. Big tech, your Nasdaq 100 up about 0.6%, a little bit better here. Remember, yesterday we had Tesla like a weight on the Nasdaq 100 and the S&P 500. You don't necessarily have that this morning, so we'll see if these gains hold. The Russell 2000, like Matt said, this was your outperformer yesterday. Not as much this morning. The Russell 2000 up about 0.4% at this moment, though. Let's take a look under the hood, because we've been talking about U.S. Steel's future as President Biden blocks a takeover bid from Japan's Nippon Steel. Now, shares of U.S. Steel are down nearly 40% since last March, and this blocking wasn't necessarily surprising, but it is surprising to see that they're surprising the shares, currently down about 7.6%, Sonali.
Merger arbs absolutely getting killed on that one. We're going to talk now about a bid building even more in Rivian, though, because shares are climbing after reporting fourth quarter deliveries that topped estimates. The company also says supply chain shortages are no longer an issue. Matt, we're going to talk more about electric vehicles in this show.
Yeah, absolutely. Looking forward to that. And Meta is replacing Global Affairs President Nick Clegg with his deputy Joel Kaplan, who happens to be the company's most prominent Republican. Let's take a closer look at what's going on with Meta. For that, we go to Washington, D.C. Bloomberg's Mike Shepard is standing by. And this is an interesting move, Mike. Is this just preparation for the Trump administration?
Well, it very much is. And a lot of companies are really engaging in that kind of introspection as we await Trump's inauguration in less than 3 weeks. But Meta has more introspection, perhaps, to do than other businesses. They have really locked horns with Trump over the past couple of years. This misunderstanding with Republicans goes back a long ways. Republicans have accused Meta and other social media platforms of what they call censorship, that is suppressing conservative speech. They haven't provided a whole lot of evidence for that, but it is added to these misgivings between Meta and the incoming Trump team. Now, Trump also got crossways with them after he was banned from Facebook following the attack on the U.S. Capitol on January 6, 2021. By his supporters. And as recently as the campaign earlier this year, we heard Trump calling Facebook the enemy of the people. And he also suggested that he might even look to reverse the looming ban on TikTok as a way of undercutting Meta, too. So there's a lot of ground for this company to make up here.
He did, though, donate. I mean, Zuckerberg donated like $1 million to Trump's campaign, though, right?
Well,
so he's trying to head that off.
Yes, he did.
Nearly to
Yeah,
the
it's not
Republican
exactly
Party.
Musk levels here, but still, it's symbolic. And of course, Mike, he did have dinner at Mar-a-Lago last month, I believe. But let's talk a little bit more about what Joel Kaplan's actual mandate here. What are some of the potential specifics that Meta is trying to accomplish here with the donations, with the dinners, and of course with this this elevation of Joel Kaplan?
Well, there is a purpose to all of this. And his predecessor, Nick Clegg, former deputy prime minister in the UK, had his own mandate, which was really to try to shore up Meta's reputation in Europe and the U.S., but in a different way. And here we see with Kaplan, he will be trying to rein in maybe some of the regulatory moves that could be coming against Facebook from a Trump administration. If Trump were to try to go after Facebook, he is someone who is known to go after anyone who opposes him. So by keeping the Trump team close, Kaplan will be able to fend off some of this oversight. And that includes on competition, on questions about child privacy, and it also includes concerns that they may be engaging in the kind of content moderation that Republicans have claimed, as I said, border on what they see as censorship.
All right, Mike Shepard, great to have you with us. Of course, a really fascinating sign of the times coming from Meta. That is Bloomberg's Mike Shepard. Let's turn now to the broader markets and to another Michael. His name is Michael Kantrowitz. He is Piper Sandler's chief investment strategist. Great to have you with us. Happy New Year. I want to go straight to one of the opening lines in your most recent note, and that is that equities should see positive gains as long as the 10-year yield and the unemployment rate remain below 4.5%. Those feel like two big ifs, Michael. How much conviction do you have that we will get those positive gains?
Well, I think we're going to see a more volatile year. You know, we've had two back-to-back years where, you know, we've had 20% increases in the equity market, obviously coming off of 2022's bear market and big increase in risk because of inflation. The market went through 2 years of basically pricing out the risk of a recession, the risk of higher interest rates, higher inflation, getting us to this point now where multiples are really high, credit spreads are super tight, and investor sentiment is fairly optimistic. And so the starting point for this year is a lot different than certainly 23 or even last year. And that I think leads to a backdrop where PEs probably are flat, potentially lower, in a backdrop where earnings are probably going to grow, but not meet the lofty expectations of about 15%. So, you know, right now we're obviously above the 4.5 level on the 10-year. And this is something we've been writing about for the last few months, and the markets have certainly struggled in the face of that. If, you know, next week we get a lot of labor data, and perhaps that could put in the peak of the last 3.5 to 4 month move higher in interest rates and provide some upside for both bonds and stocks.
So We're watching the data closely, clearly, but I want to talk about levels here because clearly 4.5% was a significant moment for investors to experience again on the 10-year. But now more and more investors and strategists, you had Julian Emanuel at Evercore ISI, you have Nick Kolos at DataTrek just this morning, watching that 5% level. What's less clear to me, Michael, is if we hit 5% on the 10-year, what is the spillover effect? Is there an expectation here that you could see any percentage point drawdown here in the S&P 500 that's on your mind?
Certainly. What we saw the last two times when markets struggled with higher rates, this was back in April of 2024, and then again in the summer of 2023. Once we hit the point where equity and interest rate correlations turned negative, basically stocks started falling until interest rates found their peak. So I would expect if yields continue to move higher, and certainly to 5%, which is a pretty big move, that would be a backdrop that gives us a correction basically until we see a peak in interest rates. I think what makes it, what's compounding this is it's not only interest rates moving higher, it's of course the dollar moving higher. And if we look at the US broad trade weighted dollar index, which includes all the emerging economies, and represents a good reflection of global trade, that is at an all-time high today, going back to the 50s and 60s. And in addition to that, this last Fed meeting, to me, changed the narrative with expectations to policy easing. In most of the client meetings I've had since that last Fed meeting, I've gotten the question if the Fed is going to potentially raise rates this year. So just the fact that investors are thinking about that is a big game changer and sentiment changer from where we were only 3 months ago in September, expecting a lot more rate cuts this year.
So if everybody, Michael, it seems like everybody is fully invested. Certainly households are more invested than they've ever been. International investors are fully invested in U.S. stocks. Institutions are holding a lot of U.S. stocks. And we're worried about the Fed raising rates, and we're likely going to see companies miss earnings expectations, right? Unless you believe they're going to do 15% earnings growth this year. Isn't that bad news for the broader indexes?
Well, it's problematic really for multiples. Even if earnings growth doesn't increase 15%, which is the current consensus expectations for this year, if we grow 8 to 9%, that should still lift equities 8 to 9%. The question, though, is in that backdrop, will multiples compress? And I think that has more to do with, again, interest rates and whether or not they keep moving higher, or perhaps we get a pocket in the next couple of months of softer data, rates come down, provide some relief. But if the unemployment data continues to tick up for more than a couple of months, then we potentially get back to a growth scare, which we last had in August. And then we see a backdrop where rates go down and stocks go down. I don't think we're quite near that risk today, but that's kind of how I see things evolving throughout the year. I don't think, like we've seen in the last 12 months or so, there's been a lot of narrative volatility. Every 3 to 4 months or so, we've seen these upturns in bond yields, and then followed by 3 to 4 months of lower bond yields. Again, on the back of softer employment data, which completely flips the narrative. And the data dependency of the Fed and investors has just exacerbated this narrative volatility that we've seen.
Michael, we thank you so much for joining us today. Of course, to start off the year, a lot of investors thinking about their risk appetite. That is Piper Sandler Chief Investment Strategist Michael Kantrowitz. Now, coming up, a shakeup across auto stocks as President-elect Donald Trump threatens to spike tax credits for electric vehicles. Yet Rivian is seeing some good news on deliveries for itself. We'll talk about it all, put it together for you next. This is Bloomberg. This is Open Interest, and you're looking live at the Principal Room. Coming up, an interview with Amy Scheer, Senior Vice President of Business Operations for the Professional Women's Hockey League. This is Bloomberg. All right, it's time now for Top Call. Some of the analyst action in focus this morning. And first up,
Wolf Research is downgrading Bumble, saying that the dating app is no longer a buy. The analyst expects more competition in the dating industry, and she has concerns about the departure of the company's longtime CFO. Next up, the homebuilder Pulte Group is getting upgraded to a buy over at Wedbush. The analyst says that the sell-off in the stock is overdone and cites a favorable customer mix. And finally, we have Raymond James turning bullish on digital payments firm Block, raising its rating on the company to a buy. The analyst expressed renewed confidence in the stock's growth story, and you can see shares currently up about 3.5%, Matt.
All right, so that's a look at some of the movers and shakers on calls. Right now, let's look at cars. Americans that are considering switching into an electric vehicle may have made their purchase after Donald Trump won the election. The president-elect's threat to axe EV tax credits looks like it gave the sector a boost with 12% growth last quarter. Joining us for more is Bloomberg Detroit Bureau Chief David Welch. And David, before we get to those who won't get the credit this year, let's talk about what happened at the end of last year. If you thought it was going to end, did you rush out and buy an EV?
I think some people probably did, but I also think that some of the growth that I think we're going to end up seeing with electric vehicle sales in the fourth quarter is just there's more on the market. There's more variety. And specifically, General Motors had a lot of new models that really got greater production. The big one being the Chevy Equinox, right? This is a vehicle that starts around $35,000 and even better equipped is around $40,000. You put a tax credit on that and you can get it for under $30,000. That's a cheap vehicle even for one that runs on gasoline in a market like this where vehicle prices are still at historically pretty high levels. So you get more variety of vehicles out there. Some of them are pretty cheap and you're going to see more volume. But look, I do think for those paying attention to the political scene, if they think that $7,500 is going to go away, especially for lease deals, yeah, go out and get one now while the getting is good. Because at the same time, there were a lot of deals offered by the automakers. So GM with some 0% financing deals on EVs, and you saw discounts elsewhere from other companies, including Tesla. And so you add all that together, and I think we'll have pretty strong EV sales once we see the final numbers come out today.
When you're thinking about EV sales as well, how do you think about this across companies, the incumbents and the contenders here? Because Rivian, of course, surprised on their delivery number, but more than 14,000 deliveries. When you think about that compared with, even with Tesla disappointing, almost 500,000, how do you think about the catch-up game?
Look, Tesla's still the huge player here in this market. It's just taken all the other companies in the U.S. anyway a long time to catch up to them. China's a different story for Tesla, but here, you're really looking at Ford, GM, and Hyundai as being the players that are going to be chasing Tesla. And I think as Ford kind of reins in its electric vehicle ambitions and their plans, the two that are really pushing with a lot more models on offer and some lower prices is going to be GM, Hyundai, Kia, the two Koreans that are really chasing Tesla. You know, Rivian's numbers are still pretty small because the vehicles they sell are still pretty expensive, even though they've dropped prices. You're looking at $75,000, $80,000 for a mid-sized electric pickup truck and SUV. It's not a great value proposition.
Even used, by the way.
People like the product. Yeah, it's just not a cheap vehicle. They've got some, they're working on lower price vehicles, but right now, their sales were down, or rather their production was down a bit. They've had some production issues as well, but they're still looking at roughly 50,000 vehicles for the year. That's tiny compared to what Tesla does, and pretty small compared to even what some of the legacy car companies are building and selling right now.
Completely anecdotally, I do feel like I've seen more Rivians on the road, though. When
I drive, Cybertrucks?
I see a lot of Cybertrucks, actually, when you drive between New York and New Jersey and upstate New York. But in any case,
I'm always happy when I see one. I'm excited when I see a Rivian.
I'm excited when I see a Cybertruck, when I see a Rivian. But David, I saw my first Lucid on the road the other day, and I thought that was really interesting. I almost crashed my car because I've never seen one before. And you take a look at Lucid shares. I mean, they're trading for just above $3 right now, not exactly soaring heights here. For these pure play EV makers who aren't Tesla and who aren't a legacy automaker that's coming into the EV space, I mean, how dire is the outlook?
Look, it's just tough for Lucid and Rivian at the prices that they're selling vehicles to get a lot of scale. And, we're seeing EV sales taper off. I mean, there's still growth there, but you're talking about companies with very small market share in a segment that, you know, is kind of hitting the, let's call it the flat part of the S curve here. We had rapid growth in EV sales for a few years, and now, you know, the customers who want to do right and get, you know, something that's green, or EVs are great luxury cars because they're quiet and fast, like all luxury cars are. A lot of those people have their EVs, and it's a matter of getting them to buy a new one or win over some other customers who are worried about charging and that sort of thing. So it's a tougher marketing challenge for all companies to sell EVs right now, because you're trying to get into the mass market and people who maybe think about EVs but aren't dying to get one. And you know, the biggest thing to overcome, I've been kind of thinking about this for a while, is people are pretty happy with their gasoline-powered vehicles, so you got to kind of pry them away from that. And so that's the challenge for somebody like Lucid and Rivian, who are selling expensive vehicles. So they're in the luxury game, and that's where competition is really tough, no matter what you're selling. And it's going to be tough for them to get scale. And they don't have an internal combustion business that's, you know, cranking out billions in cash like Ford and GM do to carry the water. So investors are going to kind of, you know, take that into consideration as well.
David, we thank you so much for your time. That is Detroit's Bureau Chief, David Welch. And of course, I get excited just when I see the charging stations. Isn't that half the problem?
You are happy with your gas-powered vehicle, though, aren't you?
For now. We'll see how the future goes.
I will repeat what I said yesterday, which is that Alex Roy drove across country in a Tesla, so from New York to California, full self-driving, and he only had to charge up for 6 hours. That's pretty shocking.
I don't know. I think plug-ins are the future, not that Tesla, as we learned yesterday, is likely to ever do that.
Speaking of the future, we're going to switch gears. Coming up next, we're going to talk about the future of the hedge fund industry, because many of them posted big returns in 2024. Details next in our Wall Street Beat. This is Bloomberg. Time now for the Wall Street Beats. The most read on the Bloomberg terminal. Multi-strategy funds of all sizes had double-digit gains in 2024. Macro hedge funds like Discovery and Point State also performed well, with some funds posting returns of over 50%. We're going to bring it down with Bloomberg's Nishant Kumar, Rob Citron over at Discovery, Zach Schreiber over at Point State. You had 52% and 48% roughly, respectively here. These strategies are not for the faint of heart. Can macro keep performing in 2025?
Well, first of all the macro hedge funds should send a gift to Donald Trump, who changed the game in November. Some funds made huge amounts of money just in the first and second week of November. Take, for example, Chris Rogo's. He printed $1 billion in a single day. And if you look at our ranking of top 5 hedge funds, it's not a ranking. Essentially, we have published the returns that we have got. Out of top 5, 4 are macro hedge fund. And the traits like long stocks, dollar, short bonds, I mean, Bitcoin, they have all contributed massively to these returns. And analysts are telling us, and even the hedge funds are telling us that, you know, these trades are going to continue well into 2025. So yes, looks like this year is set for macro traders.
Nishant, what do you need to get an edge in macro trading, for example? I mean, does size matter? Do you need one genius? Is it important to have a huge firm of research analysts? What's the key?
Well, lots of conviction and experience, probably. So some of these traders, like, you know, they have 2-3 decades behind them. They have seen all the cycles, how the markets perform, react to different market conditions. So first you need, you know, experience, you need high conviction, and then maybe smaller size to navigate this market. So Discovery is just $2.5 billion, for example. But on the other hand, you have Chris Rogo's, who does manage $19 billion, and he has, you know, printed more than 25% return so far this year.
Nishant, great having you on the program.
It's amazing. Matt, you know, some of these funds have done the best since 2020, including Izzy Englander and Exodus Point. So
best since 2020?
Yes,
wow.
Incredible.
That's impressive.
It is.
Yeah. Coming up in the next hour, Brooke May of Evans May Wealth joins us. We'll ask her why she's cautiously optimistic about the stock market this year after back-to-back 24% gains. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. You take a look at markets right now. We do have a rally on our hands. It helps that NVIDIA is up 4% right now. That is your biggest points contributor to the S&P 500, up by about 0.6%. The NASDAQ 100 up about 1%. Of course, big tech in charge, at least for today. And then you take a look at the bond market, pretty much unchanged. We do have some breaking eco data here. The December ISM Manufacturing Index rises to 49.3. The estimate had been for 48.2, and that, of course, is higher than the prior reading of 48.4, still below that 50 level. You take a look at prices paid coming in at 52.5. The estimate had been for 51.8. So interesting to see both measures actually beating estimates here, Matt.
Yeah, getting there in terms of manufacturing. I know it's not expansionary yet until it gets above 50, but it is relatively high level, the highest we've seen since April.
March.
Yeah, it's interesting also. You are seeing a little bit.
April.
For the overall index, it's the highest since March.
I'm just looking at manufacturing. You know, the interesting thing will be to see if the incoming president can bring manufacturing back. That's what he plans to do with the tariffs. But as we know, when we speak to CEOs who manufacture stuff in other countries, they say it's just too damn expensive.
I do want to also just cite the bond market movement here, because you're not seeing a massive move, but you are seeing a little spike higher in the 2-year. The reason I find that interesting is you saw that same initial knee-jerk reaction for the labor data we saw yesterday, the jobless claims, stronger economic data, yield slightly higher, a lot more economic data ahead. Let's see how much pressure on the upside that there still is.
Yeah, that is very little movement.
Well, it reversed, right? I mean, you're now only a basis point higher on the 2-year, but you are seeing traders still reading every economic data point, and I think that's what matters.
I will say, to go back
we were lower this morning.
To go back to the discussion we were having before this, I poo-pooed your best since 2020 comment, but then you, during the break, pointed out that 2020 was an exceptional year.
Oh, thank you for vindicating me.
Yeah.
I appreciate that.
Yeah. There you go. There are the manufacturing numbers. We'll see what the effects are, as little as they are on this market right now. Let's talk about the broader picture with Brooke May. She is managing partner of Evans May Wealth, and she was rated by Forbes as one of America's best wealth managers for, I don't know, the last 6 years running. One of the best in state financial managers as well. So you've got your accolades there, Brooke. What do you think after 2 easy years, right? I mean, back-to-back gains of 24%. We've had a choppy week here, or month, of trading. In December, we were down 2.5%. Does this malaise continue into next year, or is it a buy-the-dip moment?
I think that we're going to continue to see volatility, more volatility than we've seen in recent years. So investors might need to put on a seatbelt for 2025. We're optimistic, though, cautiously optimistic. We have a price target right now on the S&P 500 of 6,500, which would give us about a 10% gain in the market for 2025. It's a good time to be an investor. We've got low unemployment. We've got the economy growing at about 3%. And there's potentially deregulation and even corporate tax rate cuts on the horizon. So that's the environment that you want to be an investor in. However, we've got stretched valuations, and that poses more risk. So we're looking at companies, and we're looking at them from the bottom up. We want companies with low debt levels, fixed rate debt levels, and those that have earnings growth to back up those elevated PEs.
Well, let's talk about how you marry that together with the macro backdrop, because heading into this year, a bunch of people told us on this show that it wasn't going to be necessarily the Fed and the macro that was driving things. But then you take a look at the performance across asset classes since that December 18th Fed meeting, and it's all being driven by that hawkish cut and the idea that maybe the Fed isn't going to lower rates as much as was expected. So how do you thread together those different influences when you are looking at those bottom-up factors?
We think the Fed is still very much in play. When you look at the market, it's moving based on any comment and sentiment of where rates are going to go. We went from, in 2024, expecting 5 or 6 rate cuts, and now for 2025, we think we may only see 1 or 2. There's a 90% probability that the Fed will pause in January, and then we'll see where it goes from there. The Fed's been able to be cautious with unemployment so low, and we expect that to continue.
When you think about what you said a little earlier, too, about the S&P 500 valuations and stock market valuations more largely, what kind of opportunity is there to diversify? Because investors who had put their money in the bond market last year were pretty disappointed. Is this finally the year to get into bonds?
people can clip a coupon and get that yield. So while they might not get the underlying performance of the bond, they can still get yield, and they can get higher yields than they could get for more than a decade. So those clients that said to me, I wish I could just get 4% again, this is the time.
Yeah.
And they've gotten nice returns on their equity portfolio. So it's not a bad time to reallocate. I'm very equity biased. Our portfolios are highly concentrated in equities. But for clients that are a little bit more risk averse and we can finally get 4.5% or 5% on corporates, I think it's a good time to make a shift and add some fixed income to the portfolio.
Yeah, my eye is continually drawn to the 20-year at 4.8 and change. I know it's an unpopular. I know it's an unpopular maturity. I'm just saying my eye is drawn to it when I look at the WB screen. However, you know, if we have the right setup for business, it's a great year for equities. If we have inflation coming back, I wonder if that's a concern, and does that deter you, or are equities also a great inflation hedge?
They are. They're going to be the best hedge against inflation. That said, it's not always lock and step. So we might not get the equity returns at the same time that we have inflation, but over a longer period of time, that's where you're going to outpace inflation. When we look, though, right now, there is more risk in the environment, and so we are being cautious.
I want to talk a little bit about small caps, because the broadening out that we were so excited about towards the end of last year was really predicated on the idea that rates were going to come down and you were going to see earnings in these smaller companies actually pick up a little bit. And it feels like at least one of those we can rule out for the time being. Of course, rates coming down. How are you thinking about these smaller companies and how they're going to actually fare in 2025?
We think large cap and even mega cap is the place you want to be. In small cap, you have to be very selective. A lot of small cap companies have higher debt loads, and their debt loads are at variable rates. So when rates are higher for longer, that cuts into their profitability. So we like small caps, but really they're going to be minimal in our portfolio, and we're going to be very selective on what small cap companies we buy.
So we're pulling up a 2-year. Just before we had you, Brooke, of course, we were getting that ISM data, more strong economic data coming through the pipe. You had Treasuries getting a bid earlier in the day and now erasing those gains. You see the 2-year higher, not by much, but still 425.
A single basis point.
A single basis point.
But it's across the curve. I think to your point, Sonali, it's across the curve. It's not just the 2-year. I know you're kind of obsessed with the short end, but if you look at the 10, if you look at the 20,
also
God forbid,
also up a single
if you look at the 30,
point.
I know, but the point is the entire complex has turned around,
As
right?
they would say on Twitter, zoom out. But in any case, they are slightly higher.
I agree, 1,000% agree with the zoom out story. But if you're having drips of stronger economic data and you're watching yields really react to them still, 1 basis point here, another basis point tomorrow, another basis point after that, what's the upper bound, even on the short term, and how do you play that?
Yeah, we do think, you know, the 10-year Treasury is going to be in a trading range between 4% and 5%. So we don't think we're headed in one direction definitively right now. We think that we are going to bounce around, and from one day to the next, we're going to see yields higher, yields lower. A lot of it based on Fed comments and data, you know, that's coming in. But we should expect to see rates in this 4.5% range for some time, with some ups and downs along the way.
I think it is an important inflection to point out, just to comment on, right? Because the whole curve was green, and now it's all
the S&P
all
500
red.
being up a tenth of a percent.
Well, you know what? You pointed out this morning, Nick Colas's note. Katie always
From
reads
Data
Data
Trek.
Trek because he went to Haverford,
He
and so
did.
did she. And he says, you know what? If rates get to 5, that's the real danger zone.
Yeah.
But the best place to hide out, I think Nick would say, is large cap stocks. They've done so well, and they, in a rising rate or a higher for longer rate environment, he showed that over the past few years, they continue to do well. Do you agree?
I absolutely agree. And when we look at those big tech companies, as we know, the S&P 500 is concentrated in just a handful of names. Tech can be sensitive to interest rates, but those companies that are dominant and big players in the S&P 500, they have earnings growth. You know, yes, valuations are stretched, but they're growing their earnings 20 or 30%
Low debt,
per year.
earnings growth, and those companies are great examples of that.
Yeah, so we like mega cap, large cap. We think that that's the best risk reward.
All right, Brooke, it's really great to see you in person. Hope we'll see more of you in 2025. That, of course, is Brooke May of Evans May Wealth. Meanwhile, you take a look at markets. While we were looking at the bond market, the S&P 500 back towards session highs right now, up about 0.8%. Let's take a look under the hood now with Bloomberg's Isabel Lee.
Hey, Katie, I'm looking at Block. It's now up around 4%. That comes after Raymond James upgraded the stock to outperform with a street price of around $115. Block is now hovering at around $90. The broker said it's confident about Block's gross payment volume, or GPV. So think of GPV as a measure of the total amount of payments processed using Block's products. So the analyst sees sellers' GPV growth accelerating into double digits. Just last month, we have also Bernstein lifting its price target to a street high of 120 rather, and we also have Goldman lifting the price target last month too, so it looks like it's shaping up to be a good start of the year for Block. Block, though, posted third quarter revenue that was below analyst forecasts, but maybe this could be the turnaround this year.
Isabel, I know you're also watching Constellation after yesterday as well.
This is interesting. We have Constellation Brands. It offers juices, beer, wine, and everything. It slipped. That comes after U.S. Surgeon General said that alcoholic beverages should display warning labels indicating cancer risk. They also said that it should have a reassessment of limits for alcohol consumption. And the U.S. market of alcoholic beverage companies is significant. It's around $321 billion. We have Bloomberg Intelligence saying that if they carry the recommendation, they may face consumer backlash. But BI did say that they're skeptical that the mandate warning label will be enacted in the near term. As we know, we have political changes in Washington, and Trump is pro-business after all. So we have shares of all those companies in the red today.
Were you thinking of Constellation?
Energy, I know. It's in my mind. It's
I
the
agree.
trade du jour.
I keep looking at Constellation Brands and thinking about that too, but obviously very different
constellation.
Very different sector. X is one of the coolest tickers, right, on the New York Stock Exchange. Twitter hasn't managed to, well, I guess they're not publicly traded, but it's U.S. Steel, and they're having a rough day.
Very rough day. Its shares are sliding as much as 8.4%. That's the lowest intraday since December 10. It is the big news of the day. We have President Joe Biden blocking the $14 billion sale to Nippon Steel. And this high-profile deal has been in the headlines the past year, and it sparked a political firestorm. And others are worried that blocking this deal could increase tensions between U.S. and Japan and also chill foreign investment. It also raises question about what will happen to U.S. Steel. Will they have to restart the sale process? Maybe they'll struggle to find a buyer for the entire company. So lots of questions remain. But there is one thing that we're almost sure of, and that's a lot of litigation. We have both companies signaling that they may challenge the legal grounds of any block. And we have Donald Trump also saying that he will pledge to block the transaction. So things aren't looking good on that end. And shares are now down still around 7%, Matt.
Can you pull up a 5-year in the control room? Because I can't believe U.S. Steel has tripled in value over the past 5 years.
I was actually looking at that because I wanted to see how much the market cap has come down since a year ago. It was at $11 billion a year ago. Now it's at $7 billion. But relative to its recent history, that's pretty high.
And it's the broader ramifications. I want to point out that over the last 10 minutes or so, we have a note also from the Global Business Alliance. The ramifications of blocking the deal sends concerns, according to the alliance, that it sends a powerful and negative signal to the rest of the world. You've been talking about this, Katie.
Exactly.
That America may no longer, its longstanding open investment policy of treating U.S. employers equally, regardless of where they're globally headquartered.
When you talk about the alliance, I can only think of magicians.
I think about kind of like a Marvel-like.
I actually watched a lot of Arrested Development over the break.
Anyways, Isabel, we thank you so very much for your time. Coming up next, what are we talking about next?
Ford?
Congress.
All of the above. Congress. We're going to talk about the Speaker of the House, of course. There is a vote building behind Mike Johnson, but it's not an easy path forward. We're going to go live to Washington next. This is Bloomberg.
Wednesday, SEC Chair Gary Gensler sits down for an exclusive interview with Bloomberg's David Gura as he prepares to leave office. Tune in Wednesday at noon Eastern, only on Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. JetBlue is getting slapped with a $2 million fine by the U.S. Department of Transportation for routinely delaying some flights and setting unrealistic schedules. The penalty is a first of its kind, with Transport Secretary Pete Buttigieg saying in a statement, illegal chronic flight delays will make flying unreliable for travelers. We expect their flight schedules to reflect reality. Still, it's only $2 million. Senior right-wing politicians in the UK have been urging U.S. President-elect Donald Trump not to endorse the British far-right activist Tommy Robinson. Billionaire CEO Elon Musk, who is set to play a key role in the upcoming Trump administration, called for Robinson to be released from prison. The politicians warned that endorsing Robinson would be a step too far and would not be supported by the members of the mainstream right wing. Elon Musk, by the way, also endorsed the far-right party in Germany, the Alternative for Deutschland. And New York City's controversial congestion pricing toll is set to take effect this Sunday, but it's facing a last-ditch court challenge from New Jersey. The neighboring state is challenging the plan because of worries it could increase congestion and pollution in New Jersey. The congestion toll will charge $9 for most drivers entering Manhattan at 60th Street or below.
And speaking of driving and cars, we do have some breaking news from Ford. The automaker reporting fourth quarter auto sales were up 17%. Its fourth quarter U.S. retail sales, that is, up 17%. Its total fourth quarter sales were up 9%. And specifically when it comes to EV sales, 2024 EV sales up 38%. You take a look at the stock right now, it's not doing too much. Of course, it's been lower all morning, still lower by about 0.5%. And remember, in 2024, it was down 19%. So this is a company that needs some good news, but it seems like traders are a little bit skeptical of these results released this morning.
We're going to switch gears. We're going to focus on what's going on in Washington because it's a big moment. Congress is convening later this morning. Speaker Mike Johnson faces a re-election vote shortly. Bloomberg's Mike Shepard joins us from Washington. And a few key moments. You have Mike Johnson just saying a day ago that he thinks he can win the speakership in one vote. He has met with Donald Trump and J.D. Vance as well. Of course, the president-elect has given him his endorsement. How much weight does that carry?
It carries some weight, but it may not carry enough weight to get him over the line on that first round of voting. Johnson did say yesterday that he could do it on the first time around. But let's take a look back at the past 2 years. When Kevin McCarthy was up for the speakership in January 2023, it took 15 rounds for him to actually win the gavel. And then after he was ousted 9 months later in a coup led by ultra-conservative Republicans, it took 3 weeks for the party to settle on Mike Johnson as his successor. So there is a precedent for challenges to the speaker candidates as they come into play on the House floor. And this will put Mike Johnson in a tight position. He will have to make sure he is placating those conservatives while also not alienating moderates. You see, they need every single vote from the Republican caucus for him to really get over the line.
Do they need literally every single vote? Because I believe one member has already said he's a no. So what's the math look like? With Massey on the no side of the ledger, how many more Republicans can he afford to lose?
Mike Johnson is pretty much out of no votes. Now, the question is whether any other Republican may decide to not vote for Johnson rather than, simply vote president or go out for a long walk. But right now, the majority is the narrowest in decades that we've seen in the House. Republicans have an advantage of 219 to 215. You subtract Massey, he loses one more vote, and we are at that deadlock position. And we could be in a position where he fails to get enough votes for a few rounds. And that is when the arm twisting will really kick in, and we'll have to see to what extent Donald Trump is calling in and J.D. Vance is calling in to Republicans to either cajole them or threaten them. And we saw during the spending battle just last month that Trump was willing to threaten putting primary challenges up against anyone who crossed him.
All right, Mike, it'll be fascinating to see how it all shakes out. Our thanks, of course, to Mike Shepard joining us from Washington. Now, coming up, Sip Happens. McDonald's is switching out its iconic red and yellow striped straws, and the internet isn't loving it. Details next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Wolf Research is bullish on the pet product retailer Chewy. Wolf says that the company's sales growth potential in 2025 isn't being fully appreciated, and the analyst sees more opportunities for pet health and subscription service growth. You can see shares up about 5.5% right now. Next up, Apple is agreeing to pay $95 million in a class action lawsuit to users who say their conversations were inadvertently captured and then shared by its Siri voice assistant. The proposed settlement could pay many Apple users up to $20 per device and up to 5 Siri-enabled products. It still requires approval by a judge. And it's the final straw, McDonald's straws, at the center of a new controversy. The fast food giant is starting to replace the classic red and yellow striped straws with more sustainable clear straws, but diners aren't swallowing it. On social media, some users say that the new straws are flimsy and make the sodas taste worse, while others cite a petroleum taste. As long as they're not paper, I think I'm okay with them because I can't stand paper straws. But in any case, let's get to these markets because we do have a rally on our hands. You can see the S&P 500 is up about 0.6%, being led by big tech. The Nasdaq 100 higher by about 0.7%. The fact that you have Nvidia higher to the tune of about 4% probably helps both these benchmarks in a big way. And you did have UBS out with a note saying that that rally in AI mega cap tech names, it's not over yet, and the price action today agrees with it. Now, coming up, the farming industry is in the midst of its biggest downturn in over a decade. We'll discuss it all with the CEO of Agco next. This is Bloomberg. Well, agriculture machinery maker Agco is weathering the most significant downturn in the farming industry in a decade. The company is reducing production hours by about 25% this year, also reducing its salaried employees by about 6%, while it's also seeking to grow market share. Here with more on the company's plan to navigate this industry slowdown, I'm pleased to say we have Eric Hansotia. He is Agco chairman, president, and CEO. Great to have you with us, Eric. To start, I just want to get your feelings about 2025, because I could read you a whole bunch of stats about how rough it has been. You know them better than most. What's your outlook at the moment? Is 2025 going to be the bottom?
Yeah, we expect 25 to be the bottom. Our whole industry went through a very significant downturn, as you said, in 2024. This happens in our industry. It happened about a decade ago. There's one year where there's a big correction. That was 2024. Oftentimes, then the industry somewhat hovers around that low point for a bit and then starts working its way back up. We watch two indicators. One is the Purdue Index for North America, and one is CEMA for Europe. Both of them are already starting to move up. That's usually a future predictor of demand that's coming down the pipe. So we think 25 is the bottom.
I wonder how you expect President Trump to shake things up here. He has obviously a big take on tariffs. There's a lot of machinery coming in from Asia. On the other hand, crop demand out of Asia, crop demand in China is really important as well. So what are the changes that you see in the next administration?
Couple of things. I would say, the Trump administration has a lot of support from the U.S. farmer. A large portion of the U.S. farmer voted for Trump in this last election, as they did before. Trump has also historically been a supporter of agriculture as an industry. So those are both positives. Additionally, actually, Asia is not a huge market for the big farming equipment that we make. We really focus on high-tech machines for very productive farmers as our target. And so Asia's not a huge market. We don't bring in a lot from China to the U.S. So, in that regard, there's some positives to look at, and the issues that you raised are somewhat muted.
So to that end, Eric, what do you see in terms of the aggregate impact? If you think about the community of farmers across the country, what is the biggest kind of headwind here? Do you think that there could be demand pressures elsewhere, notwithstanding the Trump administration's moves?
Well, at the end of the day, the world still needs to eat a certain amount of grain. So what happens in one market likely could shift demand to another market. We're a very global company, so it may, maybe a less demand one farmer is the benefit of demand another farmer, like in South America or in Europe. Specifically to your question on North America, I think that the tariffs is probably the bigger question about what is the impact of follow-on tariffs to the demand of corn, soybeans, wheat, the primary products that drive farmer profitability. So that's the thing that we're watching for most closely. I would also say that the world doesn't like vacuums. They don't like uncertainty. So whatever change happens, farmers and we can manage around that. And so I think just getting clarity and certainty and getting into the new environment is a good thing.
Well, I want to talk about how you're navigating some of these headwinds, specifically at Agco, because Agco shares and your industry peers, they tend to be very closely tied to sort of the industry cycle and the peaks and valleys that you have there. I know that you're working hard at Agco to sort of divorce the share price just from the cyclicality of the industry itself. If you could give us more detail on how you're actually trying to do that, that would certainly be helpful.
Yeah, at the heart of our company, our vision is to be the trusted partner for industry-leading smart farming solutions. And essentially what we say is smart farming is making a machine with sensors on it and onboard intelligence so it can look at variation of the soil or variation of the crop to have the machine automatically do things for the farmer. Essentially like you think of an airplane being on autopilot mode. We want the machine to be in autopilot mode, handling tasks for the farmer. The reason for that is that the world needs more grain. The world needs more grain to feed more mouths, use more in biofuel, and have more meat in the diet, which is a multiplier for the more grain. So we need more output. But the society also wants less inputs, less fertilizer and chemical and herbicide and pesticide. The only way to solve that equation is technology, these smart machines. And so we have invested heavily in that. We've doubled our patent portfolio over the last 5 years. We've increased our engineering budget since I took over by 60%. We closed on the biggest ag tech deal in the history of our industry this year, where we created a joint venture with a company called Trimble, a leader in GPS systems. All of that to try and accelerate our ability to bring solutions to farmers to solve the toughest problems in agriculture. And we got a lot of momentum in that direction. 2025 will be another big year of a lot of launches for machines that can do things for farmers.
I'll surprise the ladies here with a pop culture reference.
Okay.
I'm looking at Luke Bryan's Facebook page, and he says, the rain hit us in Ohio last night. Good thing we had our Fendt tractors here to pull out all our gear. And I know that you have spent time with Luke Bryan on the farm. Fendt is your high margin, higher end line of products. You're hoping to take market share from Deere with those from the big spending farmers. How are you doing in that effort?
You know, Fendt is the best machinery line in the marketplace. It's the best of the best for the most demanding farmers. It's highest in technology, highest in quality, highest in operator comfort, and the best support network surrounding it. So we've been step by step working Fendt into the North American, South America market. It was historically more of a European brand. In the last few years, we've been bringing it to the other markets. We've been growing steadily. From 2021 to 23, we almost doubled the business, and we're aiming to double it again. And then the reason being is that once farmers get to taste and experience the Fendt product line and the overall Fendt experience, they love it. It's very sticky and they don't like to go back. So that's our mission, is we have a great product line from planters and sprayers, tractors, combines, hay equipment, and then we marry that up with top quality dealer support with our dealer organization, and we're trying to really bring this Fendt experience. The technology I talked about also comes to market on Fendt as our technology leading brand. So we have a tech business that serves directly to farmers in what we call retrofit, where we'll put it on any brand of equipment, regardless of what they had, at almost any age. But then we also have our Fendt business, which is our machines coming from our factories that bring the latest technology to the market.
All right, Eric, really appreciate you taking the time to speak to us today. That is Eric Hansotia of Agco. Now, coming up, we hit the ice with Amy Scheer. She's Senior VP of Business Operations for the Professional Women's Hockey League. That conversation coming up next. This is Bloomberg.
This is Open Interest. You're looking live at the principal room. Coming up, an interview with Apollo Global's head of credit. That's at 12 p.m. New York time. This is Bloomberg.
The Professional Women's Hockey League is skating strong in its second season. Attendance at the six-team league has jumped 35% from last season, and it's amassed 1 million followers on social media. The league broke world records for attendance at a women's hockey game in North America, and now the PWHL is ready to take the game on the road, embarking on its first ever takeover tour. Joining us now, Amy Scheer, PHWL Senior Vice President of Business Operations. On this tour, you picked 9 NHL cities for these games. Does this signal expansion into new cities, and are these the cities that you're looking at doing it in?
We're looking at a lot of cities. We're playing 3 neutral site games for the takeover tour in Canada. We're playing 6 in the U.S., and they're certainly all candidates for expansion. We're talking with all of them. It's certainly a good tryout for us to go to these markets and see how the fans respond to the games. And so, yeah, I guess you could say we're dipping our toes in the water to see how we do in these markets. Once we play these games, we'll assess how the game went, how did the arena work with us, how did the fans respond, and think about what we do for next year.
What's the pipeline look like, Amy? I'm always fascinated by the breadth of hockey coverage across the country. I would have thought, mainly Canadians are playing, but then you get, like a good team down in Florida or a good team in a place where you wouldn't expect ice hockey to be big. So what's the pipeline look like for women's hockey?
The pipeline is great. More and more girls are getting into hockey every year. The sport continues to grow. We think next year's draft class coming out of college will be stronger than ever. We feel confident that should we decide to expand, that we have the breadth of players to field 2 more teams without the actual sport suffering or the game suffering in any way. It'll still be the same high level of play. So the pipeline is there, and it's going to continue to grow, not just in the U.S. and Canada, but internationally across the globe as well.
One way that leagues have been growing, of course, is through more investor interest. And of course, when you think about the PWHL, it has had a lot of involvement from a main investor. Of course, the Mark Walter family. Mark Walter, of course, known for Guggenheim and the LA Dodgers. Is there an opportunity to bring more investors in? Are you guys actively looking for that as you expand the league?
I think we'll get to that point. I know the board is having conversations with potential investors. The interest is certainly there. A lot of the conversations we've had around expansion, the team and the arena actually wants to own the team. I don't think we're quite there yet. I think we want to continue to build the league as is. We'll certainly get to the point where we look for investment dollars at the league and team level.
Where are you getting the most investment? I mean, I see big names in terms of your sponsors, Scotiabank, Barbie, Air Canada, Molson, Shark Ninja. What about local support? Where do you feel it the most?
Well, for us, because we're a single entity, all of our sponsorship sales happen at the national or league level. And so the majority of our sponsors are either Canadian, U.S., or both North America in total. And we don't spend a lot of time focusing on local sales. We do have local partners. We've got several in Minnesota. We've got 1 or 2 in Boston. But our focus continues on national and North America.
There has been a tremendous amount of interest in women's sports in recent years, and you've seen it a lot in the NBA, for example. When you think about the potential for hockey, what are some of the data points that you're looking at that shows you the potential future growth, and why is hockey a place that more women are looking at?
Well, first of all, I think you said it at the beginning of the show. Attendance this year, year over year, is up 35%. We've had to move into bigger buildings to accommodate fan interest. Our merchandise sales are up almost double where we were this time last year. So a lot of the KPIs that we go by tell us that the interest is there for sure. Our sponsors are up. We're over 50 sponsors, partners for this year. And so the KPI is telling us that there's an interest in women's hockey. And if you come to a game and you watch a game, the game is fun. It's fun to play. It's fun to watch. It's the ultimate team sport. There's nobody goes one-on-one for the most part, right? It's 5-on-5, and you have to play as a team. But it's fun. We just need more young girls to get into the game. We need more ice time for young girls, which we're working on, putting together youth programs. But sport is a dynamic sport. It is high energy, high intensity. It is fast, and it is fun.
Well, you don't have to sell us on that, Amy. Here in New York, we're all hockey fans. But what are the building blocks? I mean, you spent years with the Nets. You spent years with the Liberty. You helped launch a soccer team. So you've been in a number of different sports. Is it really the training, the pipeline? Is it that you want to get the young kids into it so that they can be fans when they're older?
I think there's many roads you can go here, right? I think you want kids to play the game because they understand it and they come and they become a fan in a different way. But you don't certainly have to play hockey to be a fan. We need kids to play hockey because we need kids in the pipeline to ultimately want to become a player and play in the PWHL, right? You need people to aspire to be professionals, and that's any sport. But you know, hockey is a family sport as well. So even if your little brother, your big brother's in hockey, and you might not be playing hockey, you will still go to the games with your family. But you build pipelines in different ways, right? Whether it's being out in the community doing different types of programs, whether it's having unity nights at the arena, inviting different people from all walks of life in to view your sport. It's bringing people in via social. We want our players to be cultural icons, so people maybe outside of hockey follow them, get an interest in them, and then come over into the hockey ecosphere. So there's a lot of ways to build fandom. It doesn't necessarily have to be through playing the sport. It could be through a connection with a player, through someone in your family, a friend, lots of different ways.
Amy, great to get you on. Hope we can get you in the studio sometime soon. Amy Scheer there of the PWHL, from a storied career throughout sports, now in women's hockey. Great to have you on the program. I want to quickly break some news on U.S. Steel. We got some headlines crossing the terminal. Nippon Steel, the Japanese would-be buyer, and U.S. Steel, the target, would-be target, coming out and condemning the U.S. government's decision. They say they will take all appropriate action. Nippon Steel, as part of that action, plans to sue over the blocked U.S. steel deal. According to Nikkei, that wasn't unexpected.
Right. Certainly not expected, but certainly things happening quickly. I also want to point out an earlier headline from Japan's economy minister speaking to the geopolitics of this as well. He called Biden's blocking the steel deal incomprehensible. So certainly this is hitting a
inconceivable.
Inconceivable. Incomprehensible was a word he did use.
I was making an allusion
to
the Princess
Bride. It's an assertive word, right?
Yeah, no, there are a lot of
assertive
assertive words here. I mean, condemn is a pretty strong word. So they say that Biden's decision violates due process.
It's interesting to see how hard U.S. Steel is fighting for this deal to happen. Again, we were talking earlier about what U.S. Steel does from here. Can it survive as a standalone company? What would restarting the sale process look like? It seems like U.S. Steel isn't really open to entertaining those possibilities right now. It wants this deal to work.
Even though the stock has tripled over the past 5 years, it seems like they're surviving just fine.
Yeah, even still.
Coming up, the ETF industry is doing a heck of a lot more than surviving. They may reach a major milestone sooner than expected with fantastic growth over the past year. The outlook next. This is Bloomberg.
Well, 2024 was a record year for the ETF industry, with global assets surging 32%. Now, Bloomberg Intelligence predicts that those assets will reach $35 trillion even earlier than predicted. Joining us now is Bloomberg Intelligence senior ETF analyst Eric Balchunas. Eric, the suspense is killing me. We're at $14 trillion right now. When do we hit 35?
So we predicted 2035, but we can move that up a year, Katie, because this year was so tremendous. I mean, 32% asset growth would be a lot if it was a young industry, but to do this in your 32nd year, right? ETFs launched in '93. That's tremendous. Now, of that 32% growth, about 4/10 of that is from flows. 6/10 is from the market. Now, the market isn't always going to be this giving. I mean, maybe it will, but I doubt it. So we're trying to get conservative here and say, okay, going forward, let's say we get 10% a year. You get 6-7% from flows, 3-4% from the market. We feel like that's pretty tame. So if the market continues to be up and gangbusters, the date will move closer and closer. So that's where we are now. But we're pricing in, a bad year or a bad stretch that gets us to 35 trillion in that year. But, we'll see. This is 10 years out. Anything can happen.
It's amazing. I mean, we went from what, like 11 trillion and change to 15 trillion in 1 year. I was going to ask how much of this is BlackRock's Bitcoin ETF, but that's only 54 billion in inflows. So did a lot of it come from anything specific, a specific style of ETF?
Yeah, we get so wrapped up in the new kids on the block and all the shiny objects, but at the end of the day, most of the money goes to cheap beta. VOO, Vanguard's 500 ETF, took in $115 billion, which is just unbelievable. It's $65 billion over the record. And number 2 is IVV at $86 billion. And SPY was in the top 20. So at the end of the day, cheap beta is the real driver of these monster flows. But what else can you say about cheap beta? Great, you buy the index, it's over. That's why we spend a lot of time talking about the new stuff, what will be a hit and what will drive flows in the future. But that's really what drove it this year. Bitcoin helped, but Bitcoin was only like 3-4% of that total 32% growth.
A place that I'm really interested in, Eric, as well, is also not quite in the equity market. It is the bond funds, the bond ETFs here, because that's been an area of excitement. And there's been really mixed performance. You look at the longer dated maturities, for example, and the BlackRock 20-year iShares ETF did very poorly in terms of flows. How does that set the industry up for what will be popular in the year or two to come?
Yeah, it's interesting. Bond ETFs crushed their record, and bonds, I know you said excitement. I may disagree with that. They were kind of meh all year, compared to stocks and Bitcoin, of course. But there was some exciting spots. JAAA, which is the CLO ETF, took in like 10, 11 billion. That thing is really sort of shown there is white space still. But the big money went, again, into the sort of general cheap beta. AG and BND took in 13% of all the bond ETF flows. I think with bonds, active is going to be a big deal. And at some point, bonds will have this really big year, and I think that will help. But they don't really need it. I think a lot of the money, again, a lot of it's just a shift from different structures. You got mutual fund money moving over into this new format, and that's driving a good chunk of the bond ETF flows.
And I will point out that TLT, that was that ETF you were referencing, 20-year treasuries, that took in $5 billion last year, not exactly post and outflows there. So a lot of gluttons for pain in the bond market. Eric, we got to leave you there. I'll see you on Monday, of course. You can tune in to me, Eric, and Scarlet Fu on ETF IQ every Monday at 12 p.m. Eastern. And you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter. It's pretty easy to remember. But
wow. So you've got this show.
I do.
You have the ETF show.
Yes.
You've got a newsletter.
I do.
And the podcast.
With Matt Levine. And I do it all for free, actually. So there you go. Anyway,
fantastic.
Markets
we should list Sonali's different
Sonali has this
jobs.
show, Real Yield, a newsletter.
Crypto, Bloomberg Invest. Also, my newsletter's coming out right after the show, so
and the risks.
Hope you read it.
The big risks.
Oh, and the next big risk project that we're in the works for the end of the year. Excited about that. I don't know what people believe yet, so the tapings for the next.
And you can check out my Hot Pursuit podcast with Hannah Elliott, where we just talk about cars that we like. Coming up on Monday on Open Interest, Stuart Kaiser from Citi joins us, Callie Cox from Ritholtz, and Nancy Tangler from Laffer Tangler. This is Bloomberg.